afternoon, everybody. This is Dave Fuca with Cornerstone Licensing, and welcome to Tax and Operational Risk and Financial Services webinar. Really appreciate you spending the time with us. For those of you who are not able to make us today but did register, you will be getting a copy of this broadcast and also the materials that we'll be showing today. So by all means, take copious notes, but you don't need to as well. These are great slide deck that Mitch and Jennifer put together. And on that note, I just want to call out your attention to see if you're looking very closely at it and see that this is 2 years in the future. Today, February 18th, 2028 is when we're actually doing this. So welcome back to the blast of Back to the Future. So hopefully that'll put the appropriate spin on this. You can see the title. I know that you've read it in the registration, so we won't go too much into that. Let me just shift over and introduce you to it. I'm super excited and grateful to have both Mitch Petraka, founder and managing partner with Forward Firm, and Jennifer Stubas, who their tax director from Forward Firm. You're going to hear their voice more than mine. That's a really good thing for you. And their insight as well into the specifics of, addressing, what's going on today, particularly with the big, beautiful Bill Act as it turns to financing. So one last kind of detail to take care of. I apologize. Adults hate being read to, but I must read this to you. So, and I know you can read better than me, but this information is not intended to be legal advice and may not be used as legal advice. Legal advice must be tailored to the specific circumstances of each case. Every effort has been made to assure this information is up to date. It is not intended to be a full and exhaustive explanation of the law in any area. However, nor should it be used to replace the advice of your own legal counsel. Sounds like it was written by a lawyer, for a lawyer, by a lawyer. It's either way, but thank you for bearing with that. So a lot of great information, tons of stuff along the way. I love my voice, but I love Jennifer and Mitch's more. So I just want to throw it to you guys. That first question is, okay, so 100 plus tax code changes, no big deal. One big, beautiful Bill Act. Can you guys take us from the high level and we'll work down from there? Thanks.
Yeah, absolutely. Would love to. Thank you for the kind introduction, Dave. Just a quick background on myself, and I'll let Jennifer do the same before we truly dive in. But really excited to chat with everyone today. We are both CPAs. We work on a number of different types of engagements at Forward Firm. So myself, I have more of a transaction advisory and M&A background. And work as our managing partner. We also have a line of service for accounting, bookkeeping, and fractional CFO. And Jennifer leads our tax department, which obviously is the most relevant for today's discussion. And one of the most talked about of the three, just given, as you mentioned, Dave, all the wonderful changes we have this year that make us even more valuable when we think about, how to offer advice and, how to save you more money on your taxes. So excited today to chat about some of those changes and to get everyone up to speed and answer any questions. So would love any interaction from the entire group. So please don't hesitate to ask questions as we go along here. Otherwise, we'll just continue on a roll and keep chatting about, the things that we do best. So with that, Jennifer, would love if you could give a quick introduction and then we can really dive into the meat.
You got it. Thanks, Mitch. So again, Jennifer Stubas. As Mitch said, we're both CPAs. I've been a CPA for about 25 years, licensed both in Florida as well as California. I am also an EA. I kind of cheated, did the EA first before I got my master's and went back and did the CPA. I sold my previous firm in 2022. I had an exit. My mother was my business partner, and the easy way to let her go was to sell so that she could retire. I was in no way ready for retirement. I'm calling this chapter 2. I've got way too much energy to have the word retirement and my name in the same sentence. So I'm happy to be here and happy to talk about at minimum the 100 plus tax code changes from the one big beautiful bill, right? So we'll stay pretty high level here, pretty broad scheme, and happy to take any one-off questions if they do arise. But basically, there's no way for any one individual to know 75,000 pages of tax code and then to add 100 plus tax code changes to our previously existing 75,000 pages makes things quite complicated, right? But we're here to simplify that for you. So as you can see, some of the high level, big, popular topics that would be related to anybody who works in the finance industry, you can find here on our screen, right? So these are some really talkable topics that should have some interest in your line of work here. So, we're looking at some changes on the interest deduction, right? So they made it a bit broader so more people can have a larger deduction now. We can now calculate this, using different calculations. And so we no longer have to deduct depreciation and amortization before we calculate interest. We can now add those back before we calculate it. So we have a much larger interest deduction. So for those of you in the lending world, that's a selling point, right? So a larger interest deduction is now available for us. Same holds true for that R&E, right? That research and experimental credits. So previously we had to capitalize those and there was a lot of restrictions and guardrails around actually getting to those credits. Now they've loosened it up quite a bit and we can take those credits immediately. We no longer have to go back and capitalize. So for any manufacturing or anybody in that digital asset or that tech world, this is key for you, right? Big tax savings, big credits here available to you. Some of the other things that are on this slide that we can talk about just, delicately is the 1099 changes. So they've kind of opened that up a bit. We used to have a $600 minimum filing requirement, which they've now broadened up to about $2,000 limit. So giving us some more runway there before those kinds of forms have to be issued. Although they did add a new 1099 to us, the 1099-DA, which we'll talk about ever so briefly as we progress through this webinar. And then just some of the other topics here that we'll cover is there's really kind of a difference now, not so much a timing difference, but a law difference in the way that the feds handle some of these tax law changes versus the states, right? So before we used to have what I would call a simple reconciliation for some timing differences, where that got a lot more complicated now, where states are not following the feds or coattailing the feds specifically in the same language that the Fed wrote the tax law, right? States are pulling back and not as freely giving the same deductions there. Mitch, if you want to add anything here, otherwise I'm happy to move on. I think we've got some really good pieces coming behind these front slides.
Yeah, I think just the one thing to add in here and just the motivation for, the one big beautiful bill changes. And when we think about the tax code broadly and how we got to where we are today, you want to think about the kind of motivations behind what they are trying to accomplish with the tax law. And so the way our tax law comes into existence in the US is really continual iteration through the congressional process. And the reason for that is really to stimulate the economy at the end of the day. And so most of these provisions are very pro-business, pro-real estate, right? Especially when we think about one big beautiful bill. These are all things that really are helpful to us as business owners and real estate investors. And they really represent opportunity for us. So I think they're all things to be excited about. There's obviously a lot here as we're, going to cover today. But really just, that's where it becomes exciting for us is just being able to navigate and add more value through some of these changes here.
Yeah, and I just as we transition, thanks so much for kicking it off. These 6 categories, I love this. My left brain loves these things. I can put them in buckets, and I know that all 100 and whatever, 37 of them are not in here, but you had to prioritize in some way. And typically, as a project manager, I'm like, well, give me your levels of priority. Well, they're all important. They're all most important. So it's like there's no deviation. You can't like not do one. So having said that, it's always difficult to go next, but maybe the state conformity divergence and we'll, as the grab one, we'll go from there or something. Does that make sense?
Yeah. Sure does. So here's a great example of the states and the feds pulling apart and driving in different directions here. So all of these can actually be stacked, even found within the same industries. So focusing there back on the interest deduction, again, that's been expanded, giving us a larger deduction. The timing of that bonus depreciation, right? 50 states, 50 rules, one Fed. The Fed is the one who gave us the bonus depreciation, but 50 states are not following that. In fact, there's a very small number of states who actually follow the bonus depreciation with the feds. So in a situation where we're recognizing bonus depreciation on the federal return, you might have, for instance, 5 years, 7 years, 15 years, 10 years, whatever the life of that asset is, left for depreciation on your state return. So again, there's timing differences, different law changes there. The R&E, we delicately touched on that briefly, right? So no longer have to capitalize that. We can now expense that. So encouraging that R&D, those R&E exercises and projects. And then lastly, the state-specific add back, right? So although the feds might give us a deduction for one type of expense, the state may not. And so on the state return, we're having to add back to the taxable income, increasing taxable income on the state side, but decreasing it on the federal side here. So 4 broadly used topics here where we can see drastic differences between both the Fed and the state.
Absolutely. And I think the theme for what we're going to talk about today is all about jurisdictions in taxes. And so many people underestimate the effect of the different jurisdictions, especially in the United States, and as they continue to operate in more and more states. And I think that's really applicable to, the individuals who are working with Cornerstone. Generally they're getting more and more complex and into more and more jurisdictions. And, that's really where the complexity of your tax situation really starts to compound pretty quickly because of a lot of these changes across the different jurisdictions. So in many ways in the US, it's almost like we're operating as, 50 different countries in many ways with different tax codes. And obviously there's alignment in many of the categories, but in many of the things there is not. And so that's, really where there's 51 different jurisdictions, and it's important to keep that in mind at a high level.
Yeah, and I know you're going to touch on that as well, cheating, looking ahead along the way. So I'm excited about that. And I love that you're bringing it up already now because it's bringing up, tell them what you're going to tell them, and then tell them what you told them. I mean, I always love that, overall. And I think that's just a great point that cannot be overstated. So
absolutely. We try to make taxes fairly approachable, which is not always the easiest given all of that compounding noise on top of everything. But, that's really a big part of our job.
And when you're able to really do that, you'll be doing something else because that you will be the only human on the face of the earth that's able to do that. But thank you for helping us as much as you can. Great stuff. So I love this next thought of the overlooked tax trigger. This sits with us as well here at Cornerstone, but COAs. So I'm really excited to hear you talk about this. Probably might want to spend. This seems to be some of the meat as well. So
I would agree with you, Dave. Yep. So this and specifically in the finance world, right? So you're licensed and one of your clients moves to another state, so you quickly register in that state so you can continue writing for that client. Or maybe you've got a new book of business and they're expanding. And so before you know it, you start registering yourself in all these different states without really knowing whether or not you triggered Nexus or triggered a tax filing or triggered a reporting filing. If you could just be having a filing requirement, not necessarily a tax burden because of it, right? So there is a difference here. So when we talk about licensing versus your certificate of authority, right? So that certificate of authority is actually authorization to conduct business. So the state is going to deem that you have filed and requested your certificate of authority because you are going to be doing business in that state. So that's usually an automatic trigger, right? You've got some filing responsibility to that state, whether or not there's tax due, there's at least at minimum some kind of filing requirement. Now, does a licensee registering there trigger the same event? Maybe, maybe not, right? 50 states, 50 rules. So different states have different thresholds before you actually have to do any kind of filing or reporting. Then they could have a secondary threshold for when tax is actually triggered, right? So you may just be registered and not doing any business there. You may be registered and writing a lot of business there. Okay, so depending on the volume of transactions, the amount of transactions, and what kind of activity is actually happening within those state lines will determine whether or not you have a filing requirement. And so it does get a bit muddy. it can get a bit gray. So always seek professional advice as to whether or not what the activity that you're actually engaging in is a trigger for a filing requirement. Mitch, I'm sure you can attest to this in your M&A world, right? So when you get down the pipeline and you found out that this company's been doing business in several states and you're not properly registered, and now we've got hidden penalties and oops, now we've got to hold back in escrow, and it's caused all kinds of other problems. And I'm sure you can divulge a lot more in this arena here, Mitch.
Absolutely. So we do a lot of financial due diligence with the transaction advisory arm of our practice. And within that, we do a lot of tax diligence as well. I would estimate 80% of businesses, are not properly reporting in terms of their nexus requirements. They often don't understand really what it means to create that nexus. And that nexus is just a fancy word of saying you owe taxes in a specific state or jurisdiction. And so, most of the time we will discover this and it becomes a key deal issue. And so, it's not just the lack of kind of professionalism when you go to, sell a business that this affects, but also just the ability to really, hand over liabilities or fewer liabilities rather to the buyer. And so they're essentially, selling their exposure to the buyer of all these tax issues that they've created. So on the buy side, obviously, you have to be very aware of what you're purchasing and, what liabilities may be there that you're not necessarily seeing. And I would say this is culprit number one for small and medium-sized businesses of where there's kind of hidden liabilities that most people aren't aware of when they purchase a company.
Yeah, absolutely. I love your discussion prompts as a takeaway. So for the audience, if you're instructor in these, take that, focus on those, right? How many states you registered in versus do you actually operate? You really want to know that. And don't come to the table alone. Just don't get her done by yourself. Make sure legal and finance is aligned with that understatements, right? So just because you think maybe you are quote unquote getting away with it, right? It's sooner or later, it is going to catch up to you. And that's not anything that you want. Such great advice. Yeah.
Absolutely. And we see a lot of clients that get those notices 5 years later, right? And you just
Yeah.
think logically about how tax issues are caught, right? It's really mostly due to conflicting information. And so, for
Right.
example, you could see, if you're New Jersey, if you registered in New Jersey, and then, you take a look at the records of the New Jersey Tax Department, which is separate than the registration department, right? And then they talk to each other 5 years later and say, hey, wait a second, they haven't paid taxes for 5 years. And so that sort of thing happens all the time. And, we'll really see that across the board within taxes where, for example, if you purchased a company again and, you filed something differently than the seller, now you've got conflicting information, or if you failed to report a 1099 and someone else reported that for you, now you've got conflicting information. And so that's a lot of kind of how these tax issues are discovered and created and where they'll kind of catch up to you later on. So this is a prime example of that. Kind of once you create that certificate of authority and don't file any taxes in that jurisdiction.
Yeah, good stuff. Good stuff. Where you brought up nexus, I love that word nexus, right? Economic nexus, along the way. So, really let's go ahead and simplify that for Dave, right? Along the way. What do we really, really want to take away? What do we mean by all these movements? We go to expand. Expansion is good, right? I mean, we want our business to grow. We want to go to other states. Depending on who you talk to, we either have 49 or 53. I don't know, so it depends on who, whichever point of view you have, but nonetheless, we know there's a lot. So help us make sense out of that portion. Thanks.
Yeah, absolutely. Nexus just means, are you doing business in the state, right? And you think about all these jurisdictions and different tax departments. What does everyone want? They want their fair share of the pie. So if you're doing business in their state, they're going to want to collect on the business that you're doing in their state, right? And they don't care if, state X got that allocation. They believe it should be in their state and state Y and should contribute to their budget. And so really this is, kind of the push-pull, and you see the same thing with international tax law as well. And so really where your footprint is the most important thing from a tax perspective to kind of keep in mind and to fully understand is when all these kind of various, pieces are applicable to you. And so the nexus is just the fancy word that us tax folks use to basically say, are you doing business in this state and have you met the requirements to need to file taxes in that state?
And literally this state. Have
Mhm.
you filed, are you doing business in this, I mean, this
Yeah.
literal sense, in this sense, because, I'm filed in, 36 of them. Some of them show there's got to be reciprocity somewhere. And I know that's probably basic along the way, but yeah.
Yeah, and I
Keeping
would tell you,
accountable.
anybody who's experienced living in California, they claw back hard and fast, right? So they want a piece. If you've touched their borders in any fashion, California seems to get a way of getting a piece of that pie. But just to add to that, the apportionment here that has to get laid out in a tax return can get quite complicated also. So if you are earning revenue in, Dave, 30 states, right? Or some large number of states, right? Record keeping becomes so key here, right? Because your tax preparer needs to know how much revenue are you earning in each state? Did you reach that filing requirement, right? So it's one thing to register and to be producing in a state, but the record keeping of how much revenue did you actually earn in that state will determine whether or not you do have a filing requirement. So separate from Nexus, the next question becomes, do you have a filing requirement? And does that filing requirement come with tax? So there's stages and steps along the way. Once you make that initial step to register in a secondary state or third, fourth, 30th state, there's further questioning that goes behind that to really understand what your responsibility is as a taxpayer to each of these states as well as the feds.
Yeah. And I love your call out on the scenario. It's not a danger, Will Robinson or gloom and doom, but it's just just, well, we did it. We expanded 8 states. Good job. Congratulations. Somebody got a bonus, probably something award or whatever, but then bingo, boom, 6 months later, we have, half a dozen or so unfiled state returns. And that becomes extremely problematic as an understatement. So yeah, a good heads up. You had talked about, or you called out section 163J in your summary, in your initial summary. So I'm curious to hear, you must have done it for a reason. I mean, that touched a chord with you. So I'd love to hear some insight. Thanks.
Yeah, sure. So if I may, we like to use leverage. We like to use debt, right? So if we can use debt instead of our own money, we like to do that, especially when have acquisitions in play. And so now it makes it a bit more enticing that we can deduct larger amounts of interest from leveraging any of those assets that we're acquiring, right? And specifically inside of our firm, we use a lot of debt for some of our tax strategies. And so in doing so, we now have large interest deductions, or bigger interest deductions that we can now use as far as tax planning is concerned. So being that it's early enough in the year, right? It's still February, plenty of time for us to be borrowing throughout the rest of 2026 and forecasting, right? So what does that look like? If I leverage this, if I finance this, what does my interest deduction now look like? Post One Big Beautiful Bill, much larger than it was pre One Big Beautiful Bill.
Yeah.
Absolutely. And again, this goes to stimulating the economy and, what we want to really get out of these changes. It is to grow the economy, and you do that by, enticing people to make acquisitions, right, of real estate and businesses. And how do you do that? By, increasing the appeal of debt. And the easiest way to do that is by, giving you a discount on your taxes for doing so. So, a lot of these changes, again, come back to what are they trying to drive, value wise. And as Jennifer mentioned, there's a lot of advanced tax strategies we do, and a lot of them come down to this debt component and how do we shift revenue or taxes due, right, from year 1 to year 5. And a lot of this comes down to the time value of money. Taxes are impactful not just on what can you save, period, but when can you kind of defer and shift the liability to the future, right? And so that's a really important thing to understand about taxes too, is it's not just an exercise of lowering your bill as much as possible, but also lowering, the amount due this year compared to future years. And so that really can benefit you, especially as you're starting to make more investments and you're really creating kind of that compound effect of building wealth.
Yeah, great call outs, and something certainly I think would be easily overlooked as for advantageous for businesses, just like I know in your summaries, again, it seems not micro, but I mean, as far as very specific, the research and experimental expenses you talked about or called out. So, and I'm really more focused on that. And then in addition to that, audit risk, with, how can you keep me out of the audit danger area? Thanks.
Yeah, definitely. So documentation is key, right? The devil's in the details, as they say. So documentation, documentation, documentation. No different than what I just said on you might have registered in 8 different states, but we need to know how much revenue you had in those states. Same holds true with R&D, right? So where are you spending money? Is it in labor? Is it in supplies? How are you spending it? What is it that you're modifying, right? What is it that you're creating, developing? And so all of these costs that are tagged to these types of activities can be allocated into this research and development bucket. And so the larger this bucket gets, the larger your credits get. And we no longer have to capitalize them and amortize them over some length of time. We can now take these credits as the expenses are happening, which is tremendous for somebody in tech, right, or somebody in manufacturing. Huge immediate benefits now. No timing delay anymore on the R&D. This is an exciting one for us.
You feel the same way, Mitch?
Oh, absolutely.
Yeah.
Anyway, again, these are all levers we can pull as tax professionals, and which levers make the most sense depend on your unique footprint. Jennifer likes to remind me that every tax return is a unique kind of digital fingerprint of kind of what's due, and so no tax situations are exactly alike, and these are all levers that a good tax professional can pull to really improve your individual situation, and kind of which ones we pull depend on which ones we think will make the biggest difference. And sometimes some of these will or won't make a difference. And
Right.
also when you think about tax strategies, if you're kind of scrolling Instagram or TikTok and seeing some of the strategies there, right, you also, Dave, I loved what you said when we transitioned to this slide. You have to think about the risk of each of these strategies too. And so we don't like the ultra risky strategies that certain people like. And it goes back to what I was saying earlier of, when do people get into hot water with the IRS? It's, when they're using specific strategies that are clearly blacklisted or kind of under the microscope. And so, you have to think about everything, not just as, is this or is this not allowed from a tax perspective? It's not black and white. It's really a scale and spectrum of risk. And so, is what I'm doing from a strategic perspective a 7, and therefore it's probably okay out of 10 on the risk scale, or am I, 10 out of 10 in terms of what I'm doing? And obviously we never recommend anything in that bucket, as we know, it's just going to come back and not worth the effort there. So really important to think about that with your tax professional as you think about which levers to pull as well.
Exactly. And I didn't mean to jump. Did I just interrupt you, Jennifer? I thought
No,
you were
not
about
at
to say.
all.
Okay, yeah. No, you said digital, and I don't know, my brain goes to, kind of thinking along the way, AI, right? I mean, digital, of course, you have to talk your presence, right? So
Yeah.
I was a little shocked to see, like, you mean the government is using, IRS is using AI too? I mean, I thought that was just for us. I mean, that, we let them come in and use it as well. And wow, ouch, scary is my first thought, but nonetheless, anyway, I think this is a great one to come up. And I love that data profile. We can't do that, right? I thought that was illegal. I thought we weren't allowed to profile. I mean, so, but maybe data profiling is a little something different. I can't wait to hear your chat about this.
Yeah, so I would tell you back in what I would say the old day, when the IRS's computer profiled individuals. So every tax return is given a score, right? So every tax form you have as a taxpayer, so does the IRS. That's always been the case. And so they match them up. So they know what to kind of expect on your return because they have those same information forms, but what they don't have are those subjective items, right? Those charitable donation amounts, the amounts that you deduct from your rental property, those business expenses you have against the revenue that you've earned. So those are all subjective and they don't have transparency or visibility into those specific types of expenses or deductions. And so you are given a score on a tax return. And if you do fall out of a score, as Mitch said, 7 out of 10, 10 out of 10, that warrants whether or not you move into the next stage of scrutiny, right? So yes, the world is getting very smart very fast. So is the IRS, right? They do in fact profile based on your zip code. They know that if you need a certain income level to be able to live in specific zip codes throughout the country. They know if you're married filing joint and you have two children and you live in a specific zip code, that you've got to have some baseline of cost of living reporting on your tax return. And so there are ways for them to profile a return to know whether or not there's some audit risk there. Again, they know that they can't put a ton of resources after something that they're not going to gain much from, but they do have ways of profiling and understanding what they should be seeing inside your return. That does hold true with the cross-referencing, and I'll let Mitch take some of this here, but yeah, so no different than the IRS knows based on the tax forms, the states and the IRS talk just the same.
Gotcha.
Absolutely. And again, it comes down to, is your data matching the expectation? And they have so many algorithms to catch this. So really easy way of doing it is, for example, if your employer sends you a W-2, right? That big form that most people are familiar with on the tax side that says how much money you made this year. If your employer sends you that, right, and then you didn't, file taxes in that state, that's immediately going to be triggered, right? That's a very easy thing to catch. And so there are so many of these different checks that they're, automating more and more. And Dave, yeah, you're spot on. They're using AI to really be able to, capture the patterns between all of these types of things that get reported to the IRS. And, they're probably one of the more sophisticated entities when it comes to data analysis. Which is, on the converse side, it's very interesting because, they have fewer and fewer kind of individuals working on, tax issues. And so it still takes us a long time when we call them to try to resolve issues. But, the ability for them to flag things, on the upfront piece has really, really developed. Whereas the ability to resolve things, I would say, is probably getting worse. Jennifer, I don't know if you feel the
No,
same.
I agree with you.
Yeah.
I agree with you
So
wholeheartedly.
it's an interesting duality of kind of how our specific, tax agency is developing over time.
Yeah, nothing is specific or guaranteed, but I'm just thinking of you. There's my tax experts, and I'm like, hey, I want to walk the straight and narrow. Can you keep me on a semi? Can you give me a sense if I'm a 2 or a 9, out of 10 risk? I mean, you know what I mean? Can it be reversed engineered? And I know the answer is impossible because we don't know this unless you work for the IRS or have family members or something, or we're able to, break into it or something. But there has to be some things you are learning as well, right? I mean, you must have some algorithms and as well, right? To be helpful.
Oh, absolutely. There's patterns all over the place, right? There's patterns down to if our firm kept getting issues assigned to it that we're signing off on, they're going to put our firm more under the microscope as
Gotcha.
well. So they'll go to that level of pattern recognition as well. And conversely, right, if you have fewer issues, right, they're probably not going to dig in quite as much, as they maybe otherwise would. And so it all comes back to risk-based approach. And Dave, we can generally see where you are on that spectrum kind of within, two digits. So, we can get pretty close to understanding exactly what your tax risk is. And, the IRS is pretty transparent with what it doesn't like. It's just whether or not you have the time to kind of follow along. And so taxes work a lot like the legal system, where there are public rulings and there are precedents set. And, a good tax practitioner will be able to do their research if they're not sure about a specific tax position and look it up, very similar to, again, legal cases, to be able to determine, well, how is the IRS treating this? How risky is this tax position that maybe I've never come across before? So you start to see a lot of the patterns, and it's really important, to understand where you are in that risk spectrum.
Gotcha. Thanks. That's good to know for people like me. So, and following this line of digitality, I don't even know if that's a word or whatever. Can we have that? So Bitcoin, cryptocurrency, now the new 1099 DA or 1099 DA in general, the impacts of that. This is, a world beyond my world. I don't dwell in it. I don't play it on TV. So I'm fascinated by, and I would not know how to even start, to be doing the reporting for it. So thanks for your insight.
Yeah, so this is one of the newbies, the 1099 DA, right? So we've had a question for the last, if I had to guess, 4 or 5 years now. We're on the front page of the 1040. We actually have to check the box, yes or no, that you've bartered, exchanged, sold, or did some kind of use some kind of virtual currency. It was originally cryptocurrency. They've now changed the term to be digital asset just to capture more of these different tokens and EFTs, and this world has its in itself has expanded quite a bit, right? And so with that, the government wants to know who's moving digital assets, and who's moving them, who's paying with them, who's receiving them, because otherwise they don't have visibility of this. So as Mitch mentioned before, that W-2 that we're also familiar with, and most often in the finance world, that 1099 that we're so familiar with, that tells the government the amounts of money that we should be, at least our starting point of reporting on our tax return. But what they don't have visibility of is all of the digital assets and their movement. And so they've now enforced the policing of this, or the reporting of this, onto the taxpayer to voluntarily disclose that you are transacting in these digital assets, cryptocurrencies, EFTs, coin tokens, stable coins. I know there's a lot of new trendy words in this arena. Some people aren't even familiar with how to acquire or exchange these. Some people only conduct business using these kinds of digital assets. So now the government wants some knowledge as to who has it, how are you using it, and this is just, again, checks and balances for ways for them to validate that revenue is being reported correctly, and that they know where the money movement happens, right? As they always say, follow the money, right? And so that's kind of what they're doing. They're adding another form to the compliance side of things. So no different than you had to issue a 1099 to all of your contractors who work for you. We now have to issue 1099s for any currency or crypto or digital asset exchanges that we've done. Now, the one big one in this, down on the bottom of this slide, that payment processor. So this is where it gets pretty tricky, right? That merchant service. So when we go to the store and we swipe our credit card or our debit card, there's a third-party merchant service or payment processor in the middle there who has to actually facilitate collecting from one bank and remitting to another. Well, in that same transaction, the decision has to be made, who is responsible for issuing these 1099 DA forms, right? So there is a bit of uncertainty, there's a learning curve here with this one. Again, it's the newbie. So whenever we have a newbie, there's always a lot of questions surrounding it. But yeah, starting in 2026, especially in the finance world, this is one of the new players here, this 1099 digital asset. And again, it's to capture all of the activity happening that the IRS and the government doesn't have visibility of, basically.
Absolutely. And I would say too, I invest in cryptocurrencies myself, and I've made it a mission to understand that as, part of being an accountant. And, it's something that most people haven't really thought about when it comes to accounting. So there's, not a lot of exposure in the accounting industry to digital assets. So, it's something that we've worked with a lot of software on, and really you need a specific set of software to track digital assets. And so I would say that's the number one thing that people get wrong, is just their ability to track it. And really all you need is the right software synced up appropriately to whatever you're doing. And that is essentially how you can, make the most of your digital assets and, still comply with the tax perspective. And, no matter what, I think the tracking of what you're doing digitally with these assets is extremely important. And it's another area that's under the microscope increasingly, and it's changing all the time in terms of the treatment. I can tell you, within the past 4 years, we've gotten about 3 or 4 different changes, both from the bookkeeping standpoint and tax standpoint. And so, it's a new industry, and anytime you have a new industry, there's going to be these evolutions of how to treat it and how they're appropriately going to, think about it, especially as more and more institutions get involved as well.
Yeah, I love that you called out checks and balances, right, Jennifer? But so when I think of self-reporting, holding myself accountable, and I have this golf addiction, so I think like, okay, I'll call the two-stroke penalty on myself. So hopefully, those dealing with in Bitcoin and cryptocurrency are golfers or feel that as way. So right now, it really is not so much about the I don't want to say lack or absence of enforceability, but it certainly hasn't been solidified in my mind, that's really enforceable. But it's like, it's coming. It's coming. Like this is for real, and now we got a form for it and it's going to go. So, is that fair, or am I, way off on base on just kind of how read that? Again, I don't deal in that world along the way, but I love to want to understand it.
Yeah, sure. Whenever there's a new form, they want information. And if we
Yeah.
don't give it to them, it comes with a penalty.
Yeah.
Simply said.
Yeah, and speaking of penalties, they're going on that track. I love the subline on our next topic here. Where audits and transactions break, right? And I don't want to think negative. I think like audits always mean penalty, but I mean holding you accountable, right? Like you said, documentation, documentation, documentation. But I love that line. They're predictable and preventable. I mean, I so believe that. I'm a big advocate on the way, right? If you fail to plan, you plan to fail, right? Blah blah blah. So. I'm so excited to hear your insight.
Yeah, sure. So as you said, these are predictable and preventable, which means if you take the time on the front side of things and document your record keeping, properly reporting, saves us a whole lot of headache, extra time, and penalties on the back side of things, right? So these topics that you're looking at on the screen have all been touched on during this webinar here, right? So we know that if you've got a certificate of authority in a state, you've got to understand what does that mean to you in your tax return, right? Do you have a filing requirement? Mitch covered Nexus really well, right? You might be doing business in a state. Did you trigger a filing requirement? That interest expense, right? Is you were in the middle of a due diligence when the law changed. Do we have to remodel and represent to show you what and reforecast so that you know really what that interest deduction is going to look like? It's going to change the dynamics of your financial statements when you have a larger a tax deduction versus a smaller one, right? Those missed state returns, that's an easy oversight. It's a very easy oversight. In fact, I find that if as a preparer, as a professional, if we don't ask the right questions, we don't get the right answers. And so we might be asking the same question 6 different ways, and it's so that we can try and get that information from you so that we know what we have to do on our side to keep you compliant, right? Those payroll footprints, those remote employees, that's a very common work model these days, right? If you've got remote employees, did that trigger Nexus? Did that trigger a filing requirement? Besides the payroll taxes, do you have income tax? Are those employees generating revenue for the firm there? And then lastly, the R&D, again, easy enough, right? So documentation, record keeping, that is your friend. That is your best friend when you are in business. If your records are in shambles, if someone comes knocking on your door and you can't validate or provide the substance behind the deduction, it's going to cost you unnecessary money in penalties and fines.
Yeah, absolutely. And Mitch, I know you have some comments, but Jennifer, just as you said that, I think of like garbage in, garbage out, right? Asking the right questions, prompts for the AI. Hey Claude, tell me X, whatever, or Copilot, give me, So yeah, how good is your prompt? How good are your questions? How accurate, right? And getting the correct response back. But yeah.
Absolutely. Yeah. And I would just mention here, I mean, I would just reemphasize, and I'll always reemphasize to every client the importance of the accurate record keeping. And of course, the accountants are telling you to keep your books in order and to have your records be clean. But really it is a compounding issue. So, it's kind of penny wise, pound foolish, so to speak, and that you're gonna spend twice as much time in the future trying to figure out what happened, than you were if you were to just keep up with it on a regular basis. And, the compounding effects of penalties and, interest charge on the tax side and, the lack of visibility from your business side that you have when you don't have accurate financials. I mean, it is just the root cause of so many issues that we see on a daily basis. And it is the number one thing that, in many different ways, we're just pleading to people to fix because really it just, has such a great effect on everything else downstream, right? If we don't have good visibility, we're not going to be able to help you save taxes because we don't know what's going on. So it's, really important to everything about your business to have that foundational importance. Even though I know it's not revenue in your bank account, it is something that's going to save you money down the road and probably lead to better visibility, which really will kind of improve your business. And hey, by the way, when you go to exit your opportunity, having that clean ability to say exactly what's going on and show the professionalism, I can tell you you're going to get a much better multiple when you go to sell that asset. Just from seeing it, that professionalism and the ability to really give confidence in what the buyer is acquiring is absolutely paramount. So you'll thank yourself later. There's a reason why every 2-3 time entrepreneur gets really good at all these things behind the scenes, because they realize the importance of it from having learned a bad lesson about this in the past, right? And so usually it takes people, a slap on the wrist from the IRS or, something bad to happen for them to really understand the importance of it. So I would just emphasize that to every single client: get ahead of it, get your stuff in order, and it's only going to help you.
Super. And I just want to tell you, I just popping up. I'm selfishly, time is whatever. Time is time, right? So we're going. I know we have a couple summary slides. I can't wait for you guys to kind of to go to wrap up, but I don't want to wrap it up. I want to just keep hearing on this because I'm learning so much. And while there are no specific questions in the Q&A, we have a bunch of thumbs up and a bunch of clapping hands. So I know folks you're crushing it. So you're crushing on the content side. And I guess I scared everybody off and said, you're going to get this. You're going to get the handout anyway. But obviously they'll have your contact information as well. So hopefully you'll get some of those directly. But super, super job. So, and on that, I love the way you guys kind of did the high, medium, low, on this. There's no one perfect thing. Again, I kind of alluded to it when we kicked off, like everything's important. But again, we have to be able to prioritize some way. So I really appreciated why you put this together. And I'd love you to spend a couple of minutes walking us through maybe to understand why perhaps you prioritize it accordingly.
Yeah, sure. So the one big beautiful bill is the elephant in the room this year, right? So this is the one with that's drew out everyone's attention, all the new deductions. We should see some nice, tax savings really come forth. And as Mitch said, stimulate the economy starting, soon enough here once the traction picks up and the returns start flowing. So yeah, big changes there. Documentation is going to be key. So with any change, documentation, we can't stress that enough. Garbage in, garbage out, and due diligence is critical with documentation. The differences between the state and the federal, again, if federal is one thing, states is a different. You may live in one state but do business in 8 states. You've got to know what's going on the federal level and all states that you're operating in. It's not just the feds or the one state that you're living in. And if you're fortunate enough to live in one of the 7 states that don't have an individual income tax return, it doesn't preclude you from any filing requirements if you're doing business in a state that does have income, right? So that federal and state divergence, big, big, big deal. The workforce mobility, payroll, again, remote workforce ties next. We've got Nexus now. We've got apportionment issues here that we have to spread across multiple states, triggering tax. So yes, those 3 high top ones could have major tax implications and or penalties for not complying correctly. That medium level doesn't hit as many taxpayers. So that corporate AMT, $1 billion in revenue. So it's really targeting that target audience is fairly small in the scheme of things. Same thing on the OECD Pillar 2 exposure. Again, multinational group. So a very narrow group of people who that's going to be affecting. So the risk isn't so large. It's a little bit isolated and more identifiable if you're in that bucket. Expiring energy incentives. So if that was a really big deal from the last administration, that's kind of sunsetting pretty quickly here at the end of the year. So if you missed out on those energy incentives, there's not much left going forward for you. That kind of is sunsetting at this point. And then obviously the IRS delays, as Mitch said. Yeah, so they're getting much smarter on the computer side of things, but on the human side of things, much slower. So yes, those are how we feel that they should be ranked in order of priority, just by who the target audience is and who they're hitting there.
But again, depends
Yeah,
on
good.
your individual footprint, right?
Right,
Depends on your
right.
individual tax, perspective and what you're doing, right? Are you more real estate focused? Are you more business focused? Are you high net worth? Are you lower? Like there are ways that this bill affects everyone. And it just depends exactly how we can, which levers to pull and, what your exposure is in terms of risk and, where to pay more attention to depends on your unique situation.
Outstanding. Yeah, I am convinced the IRS is plugged right into my phone, is listening to me right now. So I only say nice, wonderful things about the fantastic people and all their brilliant policies at the IRS. Thank you. Please do not audit me. So that's my paranoia, not yours. But nonetheless,
That's good.
yeah, nonetheless, yeah, I know, again, adults don't like to be read to. I know folks will be able to read on this, but I love this. You took something extremely complex to this pointy head. I'm not in this realm. I appreciate it. I work, our clients certainly do, are in the realm for it, so to speak. But me personally, and I always find that is the best compliment to give when you can kind of teach somebody new or create the awareness. Is really, it wasn't so much you taught me something new or taught us, but you heightened my awareness to know, like, if I were in that shoe, their shoes, this is what I really should be paying attention to. And you gave me some really good questions to ask, specific ones, making it sound that I didn't even have to go to ChatGPT for, because I got them from Mitch and Jennifer. So that's even better. But I just wanted to give you my comments on that, and just see if there's any of one of these that you wanted to call out. And I hate to say it, but I mean, a wrap up along the way. This is our time, but kind of the kind of closure type of thing. Parting thoughts.
No, I guess no one wanted free tax advice. No questions. I'm
I,
surprised. I mean,
I
it's pretty good. We've got a decent billable rate, so if
I'm
anyone wants to take advantage last second, let us know. But happy to help and obviously look at anyone's individual tax situation. That's really what we're here for, is to work with you across growing your portfolio. And we really pride ourselves in having the continuity amongst our team to be able to help with all these things, right? Whether it's getting your books in order, which helps tax, which helps your sales, of your business and, acquiring more. It all works together, and it's really
right.
important to have that under one roof. And, we can help with all of that. And if not, we're kind of back office quarterbacks and we know who to give you off to. So, we really pride ourselves in just adding value to all our clients and, really excited to just continue to add value to the network and support people as they grow so that they can do what they do best and not have to think about, this stuff that they don't want to think about.
Yeah, thank you so much. And Jennifer, I think I stepped on you, but again, as head of partnerships, and on behalf of Cornerstone Licensing, I just can't thank you enough for being such a steward to us. And I know that reciprocity along the way, but it's fun having that connection, but doing this and even getting the detail of it, which takes time, which means you prepared before this. So you took a lot of time to get together. We are so grateful for benefit from it. And so thank you, everyone. And obviously we're on the finish slide with it. They'll know how to get in touch with you. We know how to get them in touch with you. We will be blatantly, resending this throughout the LinkedIn social media world because we just believe it so much. So thank
Great.
you. Thank you both. So nice to meet you. I look forward to, again, I know we haven't met in person yet, but I will say yet. But thank you so much for your time. And it's been a pleasure working with you.
Enjoyed it.
Our pleasure. Thank you very much for having us.
All right.
Thanks,
Have a good rest of
everybody.
your day. Thank you.
Take care.
Bye-bye.